The Reserve Bank of Australia is clearly in hawkish mode and may yet hike again. It's certainly not expected to cut until well into next year. That's in our 5 things in 5 minutes. And then in part 2 of our bonus deep dive interview, ANZ's head of Australian economics, Adam Boyton, explains why we should watch the NAIRU. That's the unemployment rate below which inflation starts accelerating.
If the NAIRU was, say, hypothetically in the high 3s instead of the low 4s, it means potentially that we can get inflation down with less of an increase in the unemployment rate.
But first, in 5 and 5 with ANZ, the Reserve Bank of Australia published its Statement of Monetary Policy on Friday. Now, that included fresh forecasts and comments suggesting the risks of more hikes in the cash rate are more prominent than cuts anytime soon. Here's ANZ Australia senior economist Adelaide Timbrell.
There was a slightly hawkish tinge to the Reserve Bank's November Statement of Monetary Policy. They have much higher expectations on inflation for the end of 2023 and higher expectations of inflation into 2024 as well. The statement really talked a lot about the risk of inflation remaining higher for longer. And while there are a lot of measures in the economy like wage growth, which wasn't upgraded, or inflation expectations, which still seem to be anchored, there did seem to be some more commentary on the upside risks to the outlook rather than the downside.
Number 2. Adelaide says ANZ's view on the cash rate's direction remains unchanged.
The Statement on Monetary Policy has not changed the ANZ view that the Reserve Bank is on an extended pause from here, but risks are still skewed towards further tightening in the near term. And the underlying assumptions in the Statement of Monetary Policy's forecast do make it seem like further tightening is possible.
Number 3. Rate cuts in Australia are still a long way off, says Adelaide.
We think that rate cuts are still very far away. The Reserve Bank noted that the persistently high inflation remains the major concern for central banks in advanced economies. And what that means is what isn't the main concern is anything that would trigger an early rate cut, like an activity fall or an unemployment rise. In fact, the Reserve Bank's staff forecasts now show less of a rise in unemployment than they did in the August forecast. So there's less reason for them to cut rates early and more reason for them to stay high for longer. We still think the first rate cut will be at the end of 2024.
Number 4. US stock markets finished last week in a buoyant mood. The S&P 500 closed up 1.6% and the Nasdaq was up 2% by the close on Saturday morning. Oil bounced too. Brent, it rose 2% to $82.24 a barrel US. The US 10-year Treasury yield closed at 4.64% and remains well off its highs from last month. Gold, it nudged down by 1.4% to $1,942.70 US an ounce. The Aussie dollar begins Asian trading this week a touch weaker at 63.61 US cents, and the Kiwi is also weak at 58.90 US cents. The US dollar really remains strong with all the geopolitical fragility and solidly high interest rates around. Number 5. In global markets, the big news over the weekend was Moody's, the credit rating agency, putting its AAA sovereign rating for the United States on review for a downgrade. It had been stable. Here's ANZ senior international economist Tom Kenny and what it might mean.
The US has got some fiscal challenges. If you're looking longer term out, budget deficits are expected to continue to be elevated and actually start rising. So there's been a lot of talk for some time about the fiscal path in the US not being on a sustainable path. And, you know, with this rise in interest rates recently, we've seen that it's more the chunk of the budget that's have to use to pay out on interest payments is growing higher. And when we add into the mix that the political environment in the US is quite volatile in the sense that polarization is quite extreme, but the US Treasury market being the largest in the world, there is confidence in the longer term that these issues will be addressed.
Tom Kenny there. Now, in part 2 of our bonus deep dive interview into why the NAIRU is falling and why that's important for interest rates, ANZ's head of Australian economics, Adam Boyton, explains the importance of parental leave in allowing a lower NAIRU and therefore slightly lower interest rates over the long run, of course, in the absence of other things.
And so the first thing is just the economy has been, or at least the unemployment rate, has been much less volatile over the past 20 years than it was, say, from 1980 through to the late 1990s. The second is that we've done a much better job, not just on female labour force participation, but also around exits that women used to have to make from the labour force when they were having children. The widespread availability of paid parental leave and the higher level of female participation with childcare now more accessible means that we're much more able as an economy and as a society to balance these childbearing or child rearing years. And so you don't see the variability in female participation by age cohort that you used to. And the other thing is we're, as a society, getting a little older. And what we find with the ageing of the population in the NAIRU is older workers tend to shift jobs less frequently. So there's a bit more stability there. And also unemployment rates tend to be higher among younger people. So as the age distribution of the economy shifts, I guess the natural rate of unemployment, I know economists wouldn't necessarily use that term, but it tends to come down a bit. And then there's also just that the economy is a little bit more flexible, that a lot of the past industrial relations reforms have probably improved the ability of the labour market to respond. And of course, inflation expectations, notwithstanding the bout of inflation we have right now, have been reasonably well anchored. So there's a whole bunch of things sitting in the backdrop that probably don't grab our attention every morning, but they're working, at least in our view, to slowly push this NAIRU down over time.
Do you think it can keep falling? Because there are some people who argue that because of COVID and because of people, moving out of the cities, looking to work less, that there might actually be a reduction in the potential for people to join the workforce and stay in it.
Well, if I think about all those big picture drivers, an ageing workforce, increased female labour force attachment, that business exits and entries are, or that the average period a business has been operating for is tending to get longer, and it's often those sort of rapid business creations and exits that can cause a bit of structural and frictional unemployment. Look, touch wood that we don't have a serious recession. I think all of those things, though, those ageing of the workforce and increased female labour force attachment, those things aren't going away. So I think we could well be on the cusp, and we might even be in the world now where the NAIRU in Australia doesn't start with a 4-point something, but is a 3-point something. So I do think these big picture things can continue, yes.
And if the NAIRU can continue to fall, how does it affect things like interest rates, all other things being equal?
If the NAIRU was, say, hypothetically in the high 3s instead of the low 4s, it means potentially that we can get inflation down with less of an increase in the unemployment rate, which I think would be a great thing. The other thing, though, is if the NAIRU is in the 3s, then it means that the challenges businesses have had over the past few years in finding employees and in finding people with the right skills isn't going to go away. And so what we could be looking at is that these labour and skill shortages, which have been, I guess, a bit more pronounced over the past few years, it's tempting to say this is just a post-COVID thing and once we've adjusted, everything will go back to normal. But if actually what we're seeing is the impact of a lower NAIRU, it's quite possible that labour and skill shortages could be with us for quite some time.
ANZ's Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, the 13th of November. Catch you tomorrow with a preview of some key US inflation figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.